Most people have a bank account without ever stopping to ask whether it is actually the best place for their money. There is another option that millions of people use and swear by, yet it flies under the radar for a huge number of everyday Americans. That option is a credit union. So what exactly is a credit union? How does it compare to a traditional bank? And which one should you be putting your money into? That is exactly what this video is going to walk you through. Let us start with the basics. A bank is a for-profit financial institution. It is owned by shareholders, and its primary goal is to generate profit. When you deposit money at a bank, that bank is using your money to make loans and investments, and the profits from those activities go back to the shareholders. The bank gives you access to your account, some basic services, and in exchange it keeps the earnings it makes from your deposits. A credit union works completely differently. A credit union is a not-for-profit financial cooperative. Instead of being owned by outside shareholders, it is owned by its members. When you open an account at a credit union, you do not just become a customer, you become a part owner. Every member of a credit union has an equal vote in how the institution is run, regardless of how much money they have deposited. Because the credit union is not trying to generate profit for outside investors, any earnings it makes get returned to members in the form of lower fees, better interest rates on savings accounts, and lower rates on loans. That right there is the single biggest difference between a bank and a credit union. One is trying to maximize profit for shareholders, the other is trying to maximize value for its members. Now, let us get into the practical differences, because this is where it really matters for your everyday finances. Starting with interest rates. Credit unions are widely known for offering higher interest rates on savings accounts and lower interest rates on loans compared to traditional banks. Because they are not profit-driven, they can pass savings back to members. If you are carrying a car loan, a personal loan, or a credit card balance, a credit union will often offer you a meaningfully lower rate. Over the life of a loan, that difference can add up to hundreds or even thousands of dollars in savings. Next, fees. Banks, particularly large national banks, are well known for charging fees. Monthly maintenance fees, overdraft fees, minimum balance fees, ATM fees. A credit union typically charges far fewer fees, and in many cases charges no monthly maintenance fee at all. For people who are just starting out or who are living on a tight budget, that difference is significant. What about customer service? Credit unions are smaller and more community-focused. They tend to be known for more personalized service. You are more likely to be dealing with someone who knows you, who understands your local community, and who has some flexibility in how they handle your account. Big national banks operate at a scale that often makes that kind of relationship impossible. Now, what about the downsides of credit unions? There are a few things worth knowing. First, membership eligibility. You cannot just walk into any credit union and open an account the way you can with a national bank. Credit unions require membership, and membership is typically based on something. You might need to live in a certain area, work for a certain employer, belong to a certain organization, or be a member of a particular community or profession. The good news is that in recent years, many credit unions have opened up their membership requirements significantly, so it is often easier to join than people think. There are also credit unions that serve very broad groups, making them accessible to almost anyone. Second, technology and digital tools. Big banks have invested enormous amounts of money into their apps, online platforms, and technology. Credit unions, being smaller, sometimes lag behind in this area. The mobile app might not be as polished. The online banking features might be more limited. This has been improving steadily, and many credit unions now have solid digital tools, but it is worth checking before you commit. Third, branch and ATM access. National banks have branches and ATMs everywhere. Credit unions are smaller and more local, so if you travel frequently or move around a lot, access can be more limited. Many credit unions have addressed this through shared branching networks, where members of one credit union can use the branch or ATM of a partner credit union, but it is still worth considering. So how do you decide which is right for you? If you value technology, nationwide access, and a wide range of financial products all in one place, a large national bank might suit you better. If you value lower fees, better rates, and more personalized service, a credit union is likely to serve you better, particularly for everyday banking, savings, and borrowing. Many people actually use both. They might keep a checking account at a large bank for the ATM access and the polished app, while doing their saving and borrowing through a credit union to take advantage of the better rates. One thing worth knowing is that credit unions are federally insured just like banks. If your credit union is federally chartered, your deposits are insured by the National Credit Union Administration, also known as the NCUA, up to $250,000 per depositor, per account category. That is the same level of protection that the FDIC provides for bank deposits. So the idea that credit unions are somehow less safe than banks is a misconception. Your money is equally protected. To find a credit union you might be eligible to join, a widely discussed starting point is the National Credit Union Administration website, where you can search for credit unions by location. mycreditunion.gov is the official resource. You can also check with your employer, your professional association, or community organizations you belong to. The bottom line is this: banks and credit unions both offer you a safe place to keep your money and access financial services. The difference is in who they are working for. A bank is working for its shareholders. A credit union is working for you. Whether that matters enough to switch depends on your priorities. But now that you understand the difference, you can make that call with your eyes open. If you found this helpful, please consider liking this video and subscribing to the channel. There is a full library of personal finance education videos here, all designed to help you understand money clearly and make better decisions. Thanks for watching.